Economist, who's the head of sovereign and institutional strategy at JPMorgan Asset Management, now joins us on the show. Good morning, Andrew. Good to have you with us on Morning Mantra. To start with, what looks to be the bigger event risk for investors in the next 3 to 6 months, Greece or rising oil?
Well, Greece is just shorthand or code for continued stresses in European financial balance sheets. In other words, the banks are still in trouble, and we understand that because not only of the sovereign risks, but also because of economic slowdowns. And Greece, in particular, is a big risk because even though we've gotten this austerity plan passed and this bailout through, you still have very difficult economic conditions facing the country and the rest of the periphery for the next 2 to 3 years. So in terms of a structural, more difficult problem to address, Greece is still front and center, or the Eurozone crisis. However, for a short-term, more tactical concern, oil prices will dominate, and the Middle East and political risk around the Iranian situation has dominated that. I think that the Iranian risk may be overstated, but again, that's just a guess on my part.
Right. Andrew, do recall for us what happened to the markets when oil peaked at about $125 a barrel in April of 2011?
Well, what's interesting is from a technical perspective, if you pull up a chart, you see when oil started moving into that 125 a barrel range, markets tried a triple top, tried to move up several times and then sold off quite sharply. Because up until that point, oil is part of the reflation trade, or the risk-on trade, as they're saying in the jargon today, and tends to track quite positively with equity prices. So as oil goes up, equity prices go up with it until it hits about 125 a barrel, because then that starts impacting macroeconomically the rest of the region, in particular Asia, and the emerging markets, which are heavily dependent on oil imports. So that starts to run down the balance of payment surpluses that many of these countries have, because now you have higher input prices, higher oil prices, and that's bad for profit margins at the corporate level. So it drags down stocks. So we get a bounce, and then we get a sell-off as equity markets start to get concerned about higher oil prices.
Andrew, now India is to come out with its Q3 GDP figure, and the expectation is about 6.3 to 6.5%. Do you think it's reasonable enough, and what could be the market reaction in case of a positive or negative surprise?
Well, the Reserve Bank of India and the government in general has been ratcheting down those GDP estimates fairly regularly. I mean, remember this time last year they were talking about 9% GDP growth. Again, oil prices are having their impact not only on the rest of the emerging markets, but in particular on India, which is a net importer. And as a result of that, inflation is picking up as economic growth is slowing down, which puts the RBI, the Reserve Bank of India, in an even more difficult situation. So economic growth will continue to slow, and what you got to keep an eye on is industrial production, which has been consistently dropping in India over the last several months, and that's a real cause for concern. And that's not just about higher interest rates. It's also about the lack of political will in India to address economic reform, privatizations, and the things that are necessary to get the Indian economy pointed in the right direction and get GDP trending up again.
Right. Andrew, we have the union budget that's going to be presented on the 16th of March. What are expectations from it, and are the investors, do you think, booking profits ahead of the big event?
Our recommendation is to be fairly cautious going into the budget because we've seen the RBI and the government in general raising their deficit spending considerably. In fact, it's up 23% from the same level last year. In other words, there's about 5 trillion rupees in borrowing from the government, which is effectively crowding out the private sector and pushing up interest rates, which makes it doubly difficult for the private sector not only to borrow money, but also to expand their operations. And combine that with this lack of political will or lack of leadership on reforms and the difficult decisions that the government needs to make to get the economy freed up again, then I would say that we would be careful and we would be booking profits going into the budget. But our view on this is that India, we should have taken profits in India over the last week anyway. We've had a great run-up in the stock market, a great run-up in the rupee, and I think you can expect anywhere from a 5 to 7% pullback in the Nifty or the Sensex.
Andrew, what is your weightage on India, and will it change in the second half of 2012?
Yeah, we continue to be neutral weighted on India, not exceptional, and again consistent with its weight in the emerging market indexes. But more importantly, we would like to add to India if we do see a pullback. So if we do get a pullback going into the budgets, and as I said, anywhere from 5 to 7%, then we would be looking to add to our weightings in India considerably, because medium term, we still are very optimistic on the outlook for the Indian economy, and we think that the Indian corporates, who have proven themselves to be extremely flexible and adaptable to this macroeconomic mess, will continue to eke out good corporate profits. So you'll see earnings per share pick up, and that, of course, will be underlying support for a market rally in the second half of the year.